Okay, good evening. I believe you guys can hear me. If you can hear me, you can send a chat. You can say yes, you can hear me. Today is Tuesday, the 28th of October, 2025, and today we will be looking at what is before us. With respect to the past examination question of ICAN on financial reporting for May 2023. Okay, we will be looking at questions that border on consolidated statements of profit or loss and other comprehensive income vis-a-vis consolidated statement of financial position. And as we also will look at it, we'll be also able to look at the consolidated statement of changes in equity. Okay, and we'll be able to use the knowledge we've had prior to now in our various classes to demonstrate our understanding of this in practical terms. And you have the opportunity of more or less consolidating the entire financial statement, excluding cash flow, at a goal. And that is what our objective is today. Now we'll quickly glance through question 3 as required by the examiner, okay? And as far as practicable, let me see if I can minimize it so that we can see it at a glance, okay? Okay. Okay, I want a volunteer. I want a volunteer to raise up hand, and I'll give you access to read the question, okay? Somebody has asked, with respect to consolidated statement of cash flow. Yes, that is the next task before us, and that might likely be on Thursday. And if not Thursday, it will be Friday, but we'll have it. Okay, I need a volunteer to raise up and read the question. Kindly signify so that I can give you access to unmute and you read the question. I've not seen volunteer, except I will have to call someone. Okay, somebody has volunteered. Whose hand was raised? I saw it and it went off. Can you raise your hands once again? Sorry, can somebody raise their hand? I can't see the person again, please. Okay, is Jonathan on the call? Okay. Victory. Okay, Victory, go ahead to unmute and read. Thank you.
Good evening, sir. Good evening, everyone. Okay, so the question.
We can hear you.
Hello? Can you hear me now, sir? Hello? Can anyone hear me? Okay, thank you. Okay, you can hear me. Okay, thank you very much. Okay, thank you. All right. Hello, sir. Please, I don't know if you can hear me. Your mic is muted.
I can hear you. I can hear you. Can you hear me too?
Yes, I can hear you now.
Okay.
All right. Thank you, sir. Okay, Olu Nigeria PLC has a subsidiary, Oba Limited, which it acquired on January 1st, 2022. The financial statements of the companies are dated below. Statement of profit or loss for the year ended September 30th, 2022 for Olu and Oba Limited. So we also have the statement of financial position as at September 30th, 2022. Okay, so let me just go to the additional information. The first one says Olu PLC acquired its 70% interest in Oba Limited.
Hello? Sorry. Sorry, before you go to the additional information, kindly list the item in the financial statement. Leave the figures. The essence of it is that it will raise consciousness of the items in the financial statement so that you can relate them with the notes. Do you get what I'm saying now? Just leave
Yes,
the
sir.
items and go to the additional information. Thank you.
Okay, sir. Okay, so in the statement of profit or loss for the year ended September 30th, 2022, we have revenue, cost of sales, gross profit, other income, distribution cost, administrative expenses, finance cost, profit before taxation. We also have income tax expense, profit for the year, other comprehensive income, gain on revaluation of property, total comprehensive income. For statement of financial position as at September 30th, 2022, we have no current assets, we have property, plant and equipment, and intangibles. For current assets, we have inventories, trade receivables, cash and bank balances. Equity and liabilities, we have ordinary shares of ₦1 each, retained earnings. For non-current liabilities, we have 10% loan notes, we have deferred tax. For current liabilities, we have trade payables, we have income tax payable. Additional information. 1. Olu PLC acquired its 70% interest in Oba Limited through a share exchange of 3 shares in Olu PLC for 5 shares in Oba Limited. At the acquisition date, the shares of Olu PLC were sold at 8 naira 10 kobo, each at the Nigeria Exchange. The parent company is yet to record the share issue in its books. 2. At the acquisition date, the fair value of Oba Limited's assets were equal to their carried amount, except for an item of plant which had a fair value of 30 million in excess of its carrying amount. This fair value increase have not been adjusted for in the books of Oba Limited. The said plant has a remaining life of 5 years at acquisition date. 3. During the year, Oba Limited transferred goods worth 40 million naira to Olu PLC. Those goods were invoiced at cost plus 25%, and only a quarter of the goods have been sold by Olu PLC at the year end. 4. Sir, please, can you scroll up a little? Hello, sir. Okay, yeah. Thank you, sir. 4. Included in the other income was 6,550,000 naira received from Oba Limited as interest paid on loan granted by Olu PLC. The loan was fully repaid before September 30th, 2022. 5. An impairment test carried out revealed loss in value of goodwill at the acquisition date of 28 million naira. 6. It is the group's policy to value non-controlling interest at their fair value. The prevailing market price per ordinary share of Oba Limited at January 1st, 2022 was 5 naira 05 kobo. 7. The gain on valuation of property arose from an independent valuation of the group's property in September 2022. 8. The administration expenses of Oba Limited included 10 million naira paid as management fees to Olu PLC, and income have been duly accounted for in the books. 9. Except where indicated, income and expenses accrue evenly over the period required. A. Prepare the consolidated statement of profit or loss and other comprehensive income for Olu Group for the year ended September 30, 2022, 12 months. B. Calculate the goodwill on acquisition and the non-controlling interest at the reporting date, 4 marks. Lastly, IFRS 10 consolidated financial statement states that a parent must present consolidated financial statement in which it consolidates its investment in subsidiaries required. State 4 exemptions to the above pronouncement of IFRS 10, 4 marks. Altogether, we have 20 marks.
Okay, thank you very much, Victory, for that reading. Okay, therefore, I will switch to the Excel that we are going to use to solve this problem. Okay, what I've done is that I've now converted the question into Excel. Okay, I've extracted the information, and as you can see here, those are the same information just spread by Victory. Okay, now we will follow the methodological manner that we always follow when we're in class, okay? And what then do we need to do? The first thing is to establish, let me see, my step 1 is to establish the group structure, okay? Now let's try and establish the group structure, okay? What is this group structure? We're told that Olu PLC, from the question, acquired the subsidiary, okay? If I can extract it here, okay? Okay. Now, this is information given to us. Now, given this structure, therefore, I can establish relationship that Olu acquires Oba, okay? And in this situation, I can just try and create a straight line. Let me insert a straight line. Now, let me insert the straight line. Okay. Now, in this straight line, I can easily identify that the date of acquisition was 1st of January 2022, okay? And the date of consolidation is our reporting date, as you can see here, which is September 30th, 2022. Therefore, 30th of September. Now, if we look at the distance between these two dates, therefore automatically, the distance here equals 9 months. Now, what this has done is that it has triggered to us that 9 months is lower than a year. And if 9 months is lower than a year, therefore, it means this is nothing other than mid-year acquisition, or what we call acquisition during the year. Therefore, there is a trigger that this is more or less acquisition during the year. Therefore, in this instance, I have to be very careful. Now, I highlight it in red. That you are aware, anything in red, it's more or less a caution. Okay, that is 9 months. I must take that into consideration. Therefore, from this, I can establish that there's control. Control exists. And who controls who? Olu controls Oba. Now, what is the stake of Olu in Oba? From the question, we're told from the question that Olu acquires 70% stake in Oba, which means if that is the case, percentage holdings Olu in Oba equals 70%. If that is the case, the percentage for non-controlling interest, NCI, will equal the difference between 100%, which is 100% minus 70%. And once we have this, we are able to establish that the sum of ownership equals 100%. Okay. Now, the next thing is to more or less look at the additional information one by one. Now, what is the first information here? The first information here is that at acquisition, and I can highlight it in bold, at acquisition date, the shares of Olu were sold at 8 naira 10 kobo each at the Nigerian exchange. The parent company is here to record the share issue in its book. And if you come back here, you find out that as at the time we're told Olu acquired 70% interest in Oba, we're told that it acquired that 70% only through share exchange of 3 shares in Olu for every 5 shares in Oba, which means we want to determine our purchase consideration. Now, in determining our purchase consideration, for figure in naira, thousands of naira, okay, let me just copy that. We're told that it's just share exchange, or what we call shares consideration. That is the only means of acquisition. Most times, it's a combination of shares and cash and other ones, which means if you have that, whatever is sum up to is our value for that period. Now we are not giving information about the share exchange. Now the information says 3 shares of Olu is equivalent of 5 shares of Oba. Therefore, I come here, Olu and Oba. Okay, 3 shares of Olu and 5 shares of Oba are equivalent. Okay. Let me target shares. Okay. Now, the question then is, we ask ourselves, how many shares were acquired by Olu PLC in Oba Limited? We need to answer that question. To answer that question, it means the question is simply 70% of the number of shares in Oba Limited. Now, the question then is, how many shares are in Oba Limited? We're not giving the number of shares, but we're giving share capital of Oba. Share capital of Oba from the yellow I highlight here is 40 million at ₦1 each, which means that numbers of Oba's shares equals share capital divided by the nominal price. Now, what is the share capital? The share capital of Oba Limited and the nominal price. Share capital, as we have it here, is 40. Remember, all figures are in thousands. Let me put it. All figures are in what? Are in thousands. Okay, and the nominal price is ₦1. Let me indicate between naira. The number of shares will be 40 million naira divided by ₦1. And therefore, we have 40 million shares. Remember, all figures are in thousands. Let me put it like that. Okay. That's 40,000 shares. Now, but what we need is how many shares? That's what matters to us. How many shares did we acquire in Oba? It means what we acquire in Oba is 70% of the 40,000 shares or 40 million shares, which is 28. And therefore, we can now simplify that the total number of shares we acquire is 28 million shares. Okay, and that is that. Now, let us take note of that. Let me put it in orange. Okay, that's the first order. Now, the question then is, if the total shares you acquire was 228 million in OBA, how many shares of Olu was exchanged for 28 million shares in OBA? And I say, how many shares of the parent, that is Olu PLC, were exchanged for OBA's acquired shares? Therefore, okay, the question then will be, you look at the ratio, which means for every 5 shares I take in OBA, I give OBA 3 of my shares, which then means that 28 million shares of OBA. If you look at it for every 5 shares, it means it's how many rounds? The number of rounds that such exchange takes place is to divide 28 million by 5 shares, which means if I do that, it will give me 28 million divided by what? 5 shares. It means it is 5.6 million rounds. Remember, all figures are in thousands. All figures are in what? In thousands. Therefore, I have this as the number of shares. That's the rounds. Now, the question then is, if that is the round, it then means that, sorry, I put it as shares now, rounds. Okay, it then means that if that is the case, then Olu will have to exchange 3 of his shares for every round. And if that is the case, then the total number of shares offered to OBA for 5.6 million rounds equal to, therefore, equal to what? Equals to 5.6 million rounds multiplied by 3 shares per round. Therefore, how do we calculate it? That means if I'm to calculate it, what will I get? It is 5.6 million rounds multiplied by 3 shares. And that will give me 16.8 million rounds. Okay. Therefore, remember, all are in what? All are in thousands. Now, that is that. Now, if I've gotten that, the next thing is then, what is the fair what? Value of the shares exchange? What is the fair value of the what? Share exchange. The fair value will equal to the market price per share at the date of acquisition multiplied by number of Olu's shares, which is the parent, offered to Oba's share what? Holders. Oba's initial shareholders. Oba's initial what? Shareholders. Therefore, what is that? What is that? It's very simple. What is the share price? We'll go back to the question. What was the share price? Olu's share price was 8 naira 10 kobo at acquisition. Therefore, you come here, remember, 8 naira. Let me copy the term. 10 kobo multiplied by the number of shares. This is round, sorry, this is shares, not round. Multiplied by 16.8 million shares. And what does that give us? That gives us 8 naira 10 kobo. Let me put it somewhere. 8 naira 10 kobo. And 8 naira 10 kobo equals multiplied by 16.8 million shares. Remember, all figures here are in thousands. Okay. Put it in there. Therefore, that is my fair what? Value. If that is my fair value, I can transfer it here as the fair value of the share quantity duration. Okay. If there's any question here, please raise up your hand or you ask by sending a chat. If there's any problem in note 1, let me know. Okay, I've not seen any answers up. Okay, I've not seen any answer. Therefore, I believe note 1 is clear. Okay. Let us now look at note 2. Note 2, at the date of acquisition, the fair value of other limited assets were equal to their carrying amount, except for an item of plant which had a fair value of 30 million naira in excess of the carrying amount. What it simply means is that everything I did here, let me call it note 1. One working. Now we have moved to note 2. Now, note 2 workings is that there is fair value adjustment in line with IFRS 3 at acquisition dates. Now, instead of them allow us to compare the fair value of plants that is different from the carrying amount, they've already compared it for us and they've given us the difference. And the result of this is that there was fair value gain because we are told that the fair value was higher. The fair value was what? Higher by 30 million. Therefore, let me highlight it. The fair value was higher by 30 million. Therefore, there's a fair value gain. Remember, all figure in thousands. By how much? 30 million. Now, the question then is, what accounting entry are we going to pass to reflect this? What account are we going to debit? What account are we going to credit? Since it's a gain, it means the value of the plant, which is a component of PPE, will move up, which means we need to increase the value. And since asset has a debit balance, we equally credit the asset the more to recognize that increase. Otherwise, if it was a fair value loss, we would have recognized a decrease. And therefore, it means we need to credit the account. And the corresponding will go to our pre-acquisition reserve, which is a component, part of what we're going to use to adjust our net asset at acquisition date. With the fair value gain of 30 million naira. Okay. Now, also, we failed to recognize accounting entry for the first note, since we are told that this transaction has not been accounted for. Therefore, let me try and shift this downwards to recognize the accounting what? Entry. Therefore, let's recognize accounting entry for this. Now, accounting entry to recognize this investment is your investments have to be recognized, which is an asset, with a debit balance. We can recognize investments in subsidiary, which is Oba Limited, a corresponding credit entry, which is equity. But there are two components of equity. The first component is of the nominal price. The second component is of the premium. Now, the nominal price goes to share capital. That's the nominal price of 1 naira. If you remember, the 1 naira, remember, 1 naira is the nominal price. Therefore, I come 1 naira. And of the share premium, the premium is excess over 1 naira. And remember, what was the share price? 8 naira 10 kobo, which means the premium is 7 naira 10 kobo. Okay, let me asterisk it so that you know we derived that 7 naira 10 kobo. Okay. Now we debit the investment with the entire amount. But remember, the entire amount is 8 naira 10 kobo. Now, for the share premium, what we are doing is that we are more or less going to credit with 1 naira times 16.8 million shares, which means, remember, we have 1 naira times 16.8 million shares, and we have excess of 7 naira 10 kobo, which is the difference between the 8 naira 10 kobo and the 1 naira will give us 7 naira 10 kobo, which we multiply by the same 16.8 million. And that is how we got this corresponding what? Entry. Okay. And that is that, which means with the fair value of the shares what? Exchange at acquisition of Oba Limited by Olu PLC. Okay, that is that. Any question on note 2? But note 2 still have further implication. The further implication is that the increase in the asset, since it's a plant is a depreciable asset. Therefore, for the 9 months in which the asset is put to use, it will have been depreciated. But it would have been depreciated at the carrying amount, or because the fair value was not reflected in the book of the subsidiary after acquisition. Therefore, we need to recognize additional depreciation on plants remeasured at fair value at date of acquisition. Now, in that regard, what then do? We ask ourselves, what is the useful life of the asset? We are told that the said assets, the said plant has a remaining life of 5 years at the date of acquisition. Okay, if that is the case, it then means that first, what is the annual depreciation? Annual depreciation will equal the 30 million divided by the 5 what? Years. Okay, recall the useful life from date of acquisition is the useful life of the plant. Is 5 years. Therefore, let me tag the years. Is 5 years. Now, given that it is 5 years, therefore, the additional depreciation will be 30 million divided by 5 years. And that comes to 6 million naira. But remember, this is annual. Then, the 9 months depreciation for the first year, depreciation adjustment for the first year, that is 2022, between January 1st and September 30th, 2022, is as follows. It will be the annual depreciation of 6 million divided by, multiplied by 9 months over 12 months that make up that year. And since all figures are in what? Thousands. What does that give us? Therefore, that gives us 6 million multiplied by 9 over what? 12 months. And that gives me 4.5 million. Okay, that is that. Therefore, what accounting entry are we going to pass in that regard? Okay. Now, the accounting entry is additional depreciation will reduce the profit of the subsidiary. And the impact of that is that the shareholder of the subsidiary would suffer. And therefore, we need to more or less apportion the burden to both the parents and the non-controlling interest. Therefore, the consolidated reserve will be affected to the tune of the parent stake, while non-controlling interest will be affected to the tune of the stake of what? NCI. And the entire credit will go to the group PP to reduce the carrying amount of that plant. In that case, we have 70% of 4.5. We have 30% of the same 4.5. And when we add it, it gives you 4.5. And the corresponding credit entry are Fed Group PP, and that is the position with depreciation adjustments arising from effects of fair value what? Gain at the date of what? Acquisition. Now, that is the end of note 2. If you have questions, kindly ask. The effect of note 2, as you can see it, is what we have on the screen. Any question? Okay. If there's none, let's continue. Note 3. Note 3 says during the year, Oba Limited transferred goods worth 40 million to Olu. Who is Oba? The subsidiary. Transfer goods to Olu or sold goods to Olu. Therefore, it means there is an upstream transaction. Upstream transaction. That is subsidiary Oba sold to parent Olu. In an upstream transaction, the first thing we need to identify is what is the profit, initial profit on sale of goods. What's the initial what? Profit on sale of goods. And the initial profit will be equal to, now in this case, they gave us cost plus 25%, which means they gave us markup. But they didn't give us the cost of the goods. They only gave us the selling price of the goods, which then means what I need is margin multiplied by the sales value. But I don't have margin. Therefore, there is a problem. I was taking it. Now, since I need margin, but have what? Markup of 25%. Therefore, I need to convert. I need to do what? Convert. Therefore, how do I convert? I'll trigger this. This is a trigger. I'll put it in red. Now, let us recall the following relationship. Markup is profit as a ratio of cost, which is the same thing as 25 over 100 as we have it there. Whereas margin is profit over sales value, which is the same thing as profit over, to determine your sales value is cost plus profit. Then, based on equation 1, above, I will substitute in equation 2 above. Therefore, since profit is 25, cost is 100, which represents 25%. Therefore, my margin will be 25 over 100 plus 25, which is same thing as 25 over 125, which is same thing as 1 over 5, which is same thing as 20 what? Percent. Therefore, I can calculate it here, which is 25 over 100 plus 25. Will give me 0.2. And if I convert 0.2 to percentage, it gives me 20 what? Percent. And that is it. Therefore, unrealized profit on unsold goods that is inventory is okay. Somebody has sent me a chat. I'll come back to that. Is margin, which is 20%, multiplied by profits on sales. And multiplied by percentage of unsold goods. Now, that is that, which means, sorry, it's profit on sale. I'm duplicating it, not margin. But what is my profit on sale? My profit on sale I've not determined my profit on sale. My profit on sale equals my margin and sales value, which is 20% multiplied by 30 million. Is that 30 million? No, 40 million, yeah. And what is that? thousands. That is 20% times 40 million. Let me put the 40 million somewhere. Intercompany sales. It's 40 million. Or figure in what? Or figure in thousands. Okay. Now, my profit on sale is the margin, 20% multiplied by 40 million. That is 8 million. And of which the percentage on sold item is how much? From the information here, we are told that those goods were invoiced at cost plus 25%, and only a quarter of the goods have been sold by Olu. If quarter of the goods have been sold by Olu, therefore, what portion is unsold is 3/4. Therefore, it means this is the same thing as equal to the 8 million multiplied by 3/4. Remember, 3/4 is derived given that 1/4 was sold. All figures in thousands. Okay, therefore, 8 million times 3/4 will give me 6 million. As the case may be. Therefore, this is what we call the unrealized what? Profit. Now, the unrealized profit now, and remember that for adjustments to consolidated statement of profit or loss, we require these three items. The first one required is intercompany sales. Second one required is unrealized what? Profit. Adjustments, intercompany sales adjustments. And finally, we require cost of sales adjustments. Okay. Now, but before then, for balance sheet purposes, we need to effect this adjustment and this unrealized profit for balance sheet purposes, the same way we have been doing before. Now, who sold to who? The subsidiary sold to the parent. Therefore, in that light, what has happened? The three subsidiary made the profits, and we are taking the profit back away from subsidiary. And in that manner, what will happen is the effect of that will affect both the parent and the NCI in the ratio of the share profit or loss, or because in an upstream transaction, the profit was made by the seller being the subsidiary and we are taking it back. And the effect is that it affects the shareholders. And therefore, what do? 70%, remember our 70% here? Now multiply by the adjustment, unrealized profits, 6 million. And also 30% multiplied by the unrealized profits, 6 million. And the corresponding entry affects group inventory. And that is the sum of 6 million. As again, I'll put it with unrealized profit adjustment. On intercompany sale of goods. Okay. Therefore, in wrapping up the adjustments, all figures in thousands. My intercompany sales, remember, was 40 million. My unrealized profit was 6 million. And if this is A, and if this is B, this will be C, which equals A minus B. And that is 40 minus 6 million. And that is that. Okay. Okay. Let me tag this. Equation 1. And let me tag this. Equation 2, as I mentioned earlier. Okay. Therefore, let me go back to the question. Sir, for note 2, if the fair value is in deficit instead of excess, how do we account for it? I think I've explained that. I said, if it's in deficit as a loss, reversal will be the case. Instead of where we are more or less debiting group plans and crediting pre-acquisition reserve, we will reverse it by debiting pre-acquisition reserve and credit group plans. And the same thing will affect the adjustment for depreciation, which means instead of debiting consolidated reserve and NCI in the proportion, the share profit or loss will be crediting them. And instead of crediting group profit, property, plant, and equipment, we'll debit it. That's what it is. Now, any question about note 3? Any question about note 3? Okay. No answer up. Now let's go back to note 4. Note 4 says, included in other income was 6.55 million received from Urban Limited as interest paid on loan. Therefore, the loan was fully repaid before the end of the year, which means This 6.55 was interest on loan. And therefore, what we just need to do is to eliminate intercompany what? Transaction. Therefore, note 4 is to eliminate intercompany transaction. And therefore, in doing that, we ask ourselves, who gave loan? For Oba to have included, for Olu to have included in his income 6.55 million from Oba, it means Olu gave the loan. And therefore, the income is in Olu's book. Therefore, we reverse the entire income in Olu's book by debiting the consolidated reserve. Okay, which equally is like debiting group what? Profit. Okay, and we credit. Now the subsidiary is the one that had the expense. Therefore, if you reverse the interest, it then means you are adding to the profit of the subsidiary, which will affect the parent and the NCI. And therefore, invariably, what we are doing is that the first credit is also coming to parent, but only that is coming at 70%. And the other one is going to be non-controlling interest, which is also going to be profits at 30%. And therefore, what do? This 6.550, here we are taking 70%. The other one we are taking 30 what? Percent. Okay. Now let's look at note 5. Note 5, impairment loss. Now, even though we don't know what the goodwill is, but because NCI was measured at fair what? Value. Therefore, the impairment on goodwill will affect both the parent and NCI, because for you to have measured NCI at fair value, you have more or less decided to recognize full goodwill. Therefore, what is the accounting entry for impairment? Elimination of intercompany interest. Here, I'll be looking at impairment of goodwill. Impairment of full goodwill. Let me call it like that. Full goodwill. And you know the reason why I call it full? Because NCI was measured at fair value. Therefore, the impairment loss which affects the goodwill was how much? Was 28 million. Therefore, I put 28 million here. Or figure in thousands. Therefore, I take 70% of 28 million. And I also take 30% of 28 million. And that is the entry to pass day. Therefore, with what? Okay, which is with intercompany interest. This with amount of impairment loss on full goodwill. Okay. Now, SCI, which is note 6. SCI, the group policy is to measure SCI at fair value. The prevailing market price is 5 naira 5 kobo. Therefore, note 6 is to accounting for non-controlling interest at acquisition dates fair value. Therefore, to do that, the first thing is to say my fair value of the equity instrument equals the market price times number of OBA shares held by NCI. And that number is simply 30% multiplied by, remember, the total number of shares of OBA was 40 million, of which Olu acquired 28. Therefore, the difference will now be of 40 million shares. And that equals in thousands. That equals, come back here, 30% of 40 million shares will give you, when the parent was 28, the NCI was what? 12. 12 and 28 will give you 40 million shares. Therefore, the fair value equals the share price, 5 naira 5 kobo multiplied by 12 million shares. This is number of OBA shares held by NCI. Okay. Therefore, that will be 5.5, 5.05 multiplied by 12 million will give me 60.6 million. Okay. Any question on that? Therefore, that is note 6. Sir, please adjust the narrative on note 4. I think I've adjusted that. Thank you. Okay. Now, note 7. The gain on evaluation arose from an independent valuation at the end of the year. Therefore, there's no problem about that. They are telling us that the gain on evaluation was as a result of post-acquisition effect. Therefore, I think that is crystal clear. Okay, and the entry has been passed. Now, note 8, the administrative expenses of OBA included 10 million paid as management fee to Olu, and the income has been duly accounted for in the books. Therefore, note 8 Okay, let me start with note 7. I'll say noted. Information noted for consolidated statement of profit or loss at other comprehensive income. Why note 8 requires workings? Note 8 requires workings. Therefore, similar to the interest we did, we also work on note 8. Okay. Elimination of intercompany management fee. Okay. Therefore, it's an income in whose hand? The administrative expense of OBA included 10 million paid as management expenses to Olu. Therefore, the income was in Olu. Therefore, we reverse it from Olu, which is the parent. Okay. And we'll also reverse it from Olu and NCI by sharing, which means the effect is that 30% of it affects the NCI. And therefore, what do we do? How much is it? 10 million? Therefore, I'll take 70% of 10 million. And I'll also take 30% of 10 million. And in intercompany management fee. Okay. That's note 8. Finally, note 9. Except when indicated, income and expense accrue evenly. Now, the examiner need not to tell you this, but as we have always said in class, it's for us to have that understanding. Okay? That when you have acquisition during the year, where the examiner is silent, you must assume that profit and loss accrue to what? Evenly. Therefore, what note 9 is saying is that we will not tell them we are aware of the need to rate the income and expenses of OBA in first year. Therefore, we are aware of that. Therefore, thank you. We are aware. Now, to do that, we can now build our consolidation schedule. Therefore, I can copy this platform and come here to build my consolidation. Now, the beauty of Excel is that I can just be linking everything. Therefore, I need my group adjustments. And I have my group. Yeah. Okay. Therefore, I'll put that in this column. And I'll put this in okay, say dark blue color. Okay, let's pick it one by one. What is my adjustment? If you remember our adjustment here for unrealized profits, on inventory, you could see here we said for sales, we are going to eliminate 40 million. For group cost of sales, we are going to eliminate 34 million, and the effect of it is 6 million, which is unrealized profit. And we can see the effects now, which means you can sum it up and you can do that, which means invariably, what is my summation? Okay. And I can sum this up. And that is it. Now, other income. Remember, I said I should eliminate in other income. Interest in, okay, that's management fee by the parents. Okay. Sorry. Yeah. Yeah, I've missed it up. Yeah. The 10 million is here. Why the 70% is there, and the 30% is there. Okay. Therefore, let me check that of the interest also. Okay. The one for the interest was right. Okay. Therefore, we've eliminated this 10 million. I'll put it here. 10 million, I have to remove it from the parent. Okay. And for the subsidiary, the management fees in the expense, I have to add it back, the same 10 million. But the effect of that, we are going to see how we adjust for it when we are attributing profit. Also, we talk about interest income. Interest income is 6.55, which constitutes interest expense. Therefore, I'll also come here. Within this other income is where the parent has recognized interest income. I equally eliminate that, which is this. And here too, in the finance cost, I eliminate that, which is the sum of these two. Okay. That is that. Now, okay. Impairment loss on goodwill. Therefore, I can get that here since it doesn't, that it is on plant, but we are not aware whether this is a manufacturing. Therefore, I'm going to treat it as operating expenses. Impairment loss. Sorry, I'm talking of additional depreciation. I'll treat it as expenses, but let me insert impairment loss on goodwill. Therefore, impairment loss on goodwill, we have the sum of 28 million, which is additional expense. Put it in brackets as an expense. Okay. And also we have additional depreciation. We are not told this is a manufacturing company. Therefore, I'll have taken the depreciation adjustment to cost of sales, but generally, I'll take it to administrative expenses. Therefore, the additional depreciation will increase my administrative expenses. Therefore, it's negative. How much is it? Okay, that's 4.5. Okay, that is that. Now let's pick the adjustment. Which other one affect profit or loss? We've dealt with additional depreciation. We've dealt with, okay, unrealized profit, we've dealt with that. We've dealt with intercompany interest. We've dealt with impairment loss on goodwill. We've also dealt with management fee. Now, the only one we have not dealt with is note 9 that says we should prorate the income and expense for OBA in year 1. Now, let me link this. Now, I've linked it. Therefore, let me repaint it so that it looks cleaner. Yes. Now, similarly, for OBA, it's supposed to be 9 months. Therefore, I'll take note of that. Okay, let me just put it on top. 9 months. And this is 12 months. Just take note of that. And if that is the case, therefore, I'll rate it 9 divided by 12 multiplied by what I have here, which means this is 9 months. I do the same thing. And see that I skip that of the impairment for goodwill because it's not in the account initially. Therefore, okay. I link it to a wrong place. Okay. From where I linked it wrongly, it is cell B instead of C. Okay. Therefore, all other information remain the same. Therefore, I can sum everything up. Also, Let me see whether it jives. 89.73. Yeah, it jives. Now, doing that, therefore, I can attribute this. Profits for the year attributable to parent, NCI, and total. Therefore, I have profit for the year. Now, profit for the year, I have the one for the parents, Olu PLC, and I have the one for Opa Limited. Now, the one for Olu will come to Olu alone. The one for Oba will come to Olu, 70%. And 30% for NCI. Now there's group words adjustments. Under group adjustments, remember we have unrealized profits. And the adjustment we have agreed with respect to unrealized profit is that it affects NCI by 1.8 and parent by 4.2. Therefore, from here, negative 4.2 and negative 1.8. We also have issues about that on additional depreciation on plants. Also, we said it's going to affect NCI 1,350 and parent 3,150. Therefore, parent is 3,150, NCI is 1,350. What other one? Interest. Okay, intercompany interest. There's one for Olu. And there's one for what? Oba. Olu is income, therefore we are reversing it. Oba is expense, we are also reversing it. For Olu, we are reversing it negatively, the interest. Is this. We said we should debit. While for Oba, we said we should credit. And it's to the benefit of the parent and NCI in the ratio they share profit or loss. Management fee for Olu is an income initially. For Oba, it was an expense. And therefore, similar to interest, we reverse it. For Olu, negatively, while the one for Oba, positively, we reverse it to the benefit of Olu, 70%, and NCI, 30%. We also talk about impairment of goodwill. Impairment of goodwill We apportion it since it's a full goodwill. 70% goes to the parents negatively, and 30% goes to the NCI negative. Now, if those are all the additional information, therefore, we can sum up everything. Now, for total comprehensive income, to table 2. Therefore, we start with profit for the year, which we have already determined to be this amount. We will now come to OCI. Let's pick them one by one. But fortunately for us here, we only have one item for OCI. And what was the item? Gain on revaluation. Therefore, we have for Olu and we have for Oba. Olu's own will go to Olu alone. And how much is it? 26.6. Why Oba will go to Olu and NCI in the ratio of 70% of 5, if you can see it, of 5, and 30% of that 5. If you can see it once again, and that's sum it up. Therefore, the summation we can sum this up. This. Okay, which means here I have 59393, but it's not agreeing 52843. Therefore, what have we missed up? Remember, we remove this for administrative expenses. What was the adjustment we passed? The 4.5, which increases our stuff, and the other adjustments. Now let's check. Now for admin expenses, what do we do? Here we add back then, yes. What's different between 59393 and this? Let's trace it. That's 6550. We have 6550 somewhere. That's interest, 6550. Did you deduct it? Interest under finance costs. Yes, we did that. What about under interest income? We did that. Sorry. Yes. Okay. Okay, we didn't deduct finance cost here. We deducted. Yes. Therefore, what will have happened? It's netted off. It's netted off. Okay. Okay, I get it. Okay. As M8 is what? Okay. Yeah, this is duplicating because the M8 already refers to 10 million. Therefore, don't let me use M8. He has double counted. That's why when you model, you have to be very careful. Let me just go and take the 10 million alone. It's taking both the 10 million and 6.5. And where's the 10 million for management fee? That's the 10 million. Yeah. You must not pick anything from M. Yeah. Okay. Yes. Now the sign, I made mistake on the sign, and that's why it's now 52. Okay. Lastly, now remember, Oba's profit evaluation is not 100%. We have to prorate it for the whole of the 5 have to be used because we are told that this evaluation happened at the end of the year. Therefore, it will be wrong for us to prorate it here. That is what it is. And we already acknowledged that we noted that information, but we didn't act on it. This is information, note 7. Note 7, let me put it in red, is an alert. And I'm also going to highlight it in yellow. We claim we acknowledge it, but we didn't act on it. It says it is the gain on evaluation arose from an independent valuation in September. Therefore, we are not to prorate that because it was actual evaluation gain that occurred at the end of that year. Therefore, it was wrong for us to have prorated that, and that's what caused the difference. Now, it has tallied. You can see profit for the year is now attributed 52, and our total comprehensive income 84. And that is that. Now, that is that just for the profit or loss. Now, for the balance sheet, it's also straightforward. And what will I do for the balance sheet? I come here to replicate the balance sheet. Okay. Now for the balance sheet, remember I have my figures. I'll start with my plant. What is the value of my plant? I'll add the 2 years together and I'll adjust for all of the adjustment. What are the adjustments that affect a plant? At acquisition date, I increase the value of plant by 30 million. Therefore, I'll add 30 million according to the entry that we have passed. Okay? Now, and I'll deduct depreciation based on the entry we've passed. And that gives me the value of that. Intangible assets. We have intangible assets before now, but now we're also having goodwill. Therefore, what I would likely do is to show goodwill separately. Therefore, I'll have goodwill and I'll have other intangible assets. I'll call it others. For others, I can easily sum it together. What do I have for others? 34 plus 0. And I'll wait until I get my goodwill. And I'll sum both my goodwill and others. And it will update later. At that point, I can get my total. I can get my total non-current assets. Now for inventory, I come back, I add the parent and subsidiary. I adjust for unrealized profits. Unrealized profit on inventory. Remember, we said we should reduce it by 6 million. And I've done that. My trade receivable, I don't have intercompany balance. Therefore, I just sum the two together. Likewise, my bank, no adjustment for bank. I add the two together. And therefore, I can just drag down. All things being equal, I sum that together. And it have my total, I'm able to get my total current assets. Sorry. Let me move this here. Therefore, my total current asset. And what's my total asset? All things being equal, this plus this. And it will change once we update our goodwill. Now, my share capital. The share capital is only for the parent. And that was 100 million. But remember, there was additional share capital issued, which we issue at the start under note 1. And we said we should increase our share capital by 16,800. Okay, we don't have premium before, therefore I'll create premium account. Share premium. Under share premium, I link it to my share premium based on the adjustment we made. Premium of 119. My consolidated earnings, I'll link it thereafter. And if I link it, it will update my total equity. Not loan note. Therefore, we don't have any intercompany loan balance because it was repaid. Therefore, I sum these two up. Similarly, I sum my deferred tax up. And we're not doing adjustment for deferred tax. Therefore, all things being equal, I sum this up. Trade payable. There's no intercompany trade payable. Therefore, I just sum this up. And likewise, I sum my tax up, income tax payable. All things being equal, my sum total of current liability is this, and my total liability and equity is the summation of these three items. Now, what are the adjustments I need to go and prepare? The first adjustment I need is, how do I get my goodwill? Therefore, I have all my information to determine goodwill. And what are they? All figures in thousands. What is my cost of business combination? Olu investment in OBA and not controlling interest. What was Olu's investment? Remember, we've done that in working note 136. What is OBA? OBA was measured, NCI was measured at fair value, and that's 6,600. Therefore, I can sum the two together, and that gives me 196. I compare this 196 with the fair value of OBA's net assets at the date of acquisition. And that is made up of share capital of OBA and pre-acquisition reserves. And what is that? Share capital is 40. Now, we're not giving pre-acquisition reserve, but we can work back. Since our profits for 9 months, if you remember, our profit for 9 months, this is a 9-month result. Since our profit for 9 months is 14,738. If you remove it from the retained earnings at the end of the year, all things being equal, it will give you your pre-acquisition reserve. And therefore, our pre-acquisition reserve here will be 550 minus, I hope I got it right, 5550 minus our 9-month results, which is 14,738. 14,738. Remember, all figures are in Naira, thousands of Naira. Therefore, It is 50 minus 14. And that will give me this. From there, I can sum this up. And that's the carrying amount. That's the carrying amount of the net worth asset. Therefore, but I'm to adjust it to the fair value gain on plants. Remember, fair value gain on plants was 30. If you remember, we said we should credit our pre-acquisition reserve. That will increase it. And when we sum it up, what do we have? We now have this amount. And once you deduct this amount, we can obtain our full goodwill acquired. That is goodwill at the point of acquisition. Okay. Now, this goodwill have suffered impairment loss. What is impairment loss? Remember, the impairment loss we charged was 28 million, somewhere here, yes. Therefore, I put it in negative. And I sum it up. And that gives me goodwill, or I call it consolidated goodwill, or goodwill on consolidation. Okay. Goodwill on consolidation, I can bring it here, as I've said earlier. And that is it. It updates that. Now, the final one we need to do is the consolidated reserve. And what? NCI at acquisition date. Sorry, as at consolidation date. Now I have consolidated reserve and have NCI. All figures in 1,000. Now we start with Olu's, that is parent reserves. What is Olu's reserve as per account? Is this. We now go to post share of post acquisition reserves of OBA. Okay, what's post acquisition reserve of OBA? Remember, the reserve of OBA was 50. But this 50, they are entirely, it was 50. But at the beginning of the year, we have no reserve brought forward. But as at the end of the year, what was the post-acquisition reserve? We need to ask ourselves a question. But our share of post-acquisition reserve. Now, what is the post-acquisition reserve in this case? It's simply what was created in that year. Okay? Now, what was created in that year is how much? If we come back to our consolidation schedule, yeah, you find out that we have 14,738, okay, which is a component of that in that 550, 550. Therefore, I'm going to prorate that and take 70% of 14, and I'll take 30% of 14 to NCI. Now, remember that the subsidiary was acquired in that year, therefore, added on acquisition of OBA amount of NCI that we measure at acquisition date. If you remember, NCI we measure at acquisition date is how much? NCI is 6,600. Okay, that is that. Next, we now pick up group what? Adjustments. What are the group adjustments we have that affect my consolidated reserve and NCI? They are similar to the adjustment I have here already. I can just copy this line and pick what is relevant. Okay. Now, unrealized profit. What is the effect? Instead of me to waste time, I have it here. The effect here is this. Therefore, I can just track all of the effect the same way I've adjusted for it before. And all of them affect my post-acquisition. And if I sum it up, provided I didn't miss any item, sorry, the parent reserve, I wrongly put it under NCI, no? Let me re-add it. The parent reserve comes under consolidated reserve, and NCI comes here. Now, all things being equal, let me now link this back and see what it is. Now, let me go back to my balance sheet. What is my retained earnings? I link this. What is my NCI? Therefore, I need to now incorporate my NCI, which means this I have is my equity attributable to the shareholders. That's the shareholders of Ulu. And therefore, what do I do at that point? I sum this up. And that gives me this amount. Okay? Now, the next thing is to bring in equity attributable to non-controlling interest, NCI. Once I do that, now I sum this up. And the account balance in this slide. Now, even though we are not told to show the balance sheet, but I decided to show the balance sheet so that you can have a fair understanding per venture. You are required to do that in the examination hall. Okay, another thing that I wanted to show you is what if you are asked to prepare the consolidated statement of changes in equity? How will it look like? But before then, remember, I still have to present my consolidated statement of profit or loss in a manner suitable for presentation. And you see what I'll do? I'll just copy and paste this and come here, put it here. Therefore, what do I need? Now, total comprehensive income. I put it there. I already need this. I need it. Okay, therefore I don't need this. To use group. Let's say consolidated statement of profit or loss and other comprehensive income. Okay, therefore, I just link it straight. I don't need to do anything. Just link everything here. Okay, that is just it. So that I present it as a single item. And here, I don't need this. And it's total. Therefore, profit attributable to owners of Olu PLC. And the second one is to non-controlling interest. Therefore, what I've attributed before, I just need to link it to what I've done. This is for parent Olu. And the second one is for NCI. And that sum up to what you have in your account, which is 52843. Similarly, I'll do the same thing for this. For total comprehensive income, I go back, I link it to total comprehensive income. for OU, and as you can see it for NCI. I also sum it together. And that is that. Therefore, this is the result I present for this. Why this is working? This one is working, the consolidation schedule. Now, finally, I said, what if I want to present consolidated statement of changes in equity? Therefore, how will I do that? I change this to okay. Therefore, I have share capital, share premium, and that. Therefore, I can come here and say I have share capital, I have share premium, I have retained earnings, I have equity of the parent, I have non-controlling interest, and have total equity. All figure in thousands. As I've told you in class, start with the unknown. The year runs from October 2021 to September 2022. Therefore, start with profit for the year. Profit for the year, I know what it is. Therefore, remember, we've attributed it here. This is, since there's loss, I can say profit. There's loss for NCI because the adjustment exceeded the profit. Therefore, NCI has a negative. Therefore, I've done that. Other comprehensive income. Therefore, I have gain or evaluation of property. Now, how do we attribute it? The parent aspect of the gain. Therefore, that means I have to create that evaluation reserve. Which is a component of, other component of equity. Let me just put it like that. Okay. Therefore, the gain on evaluation, if you go back to the adjustment we made, parent will take all of his own plus 70% of the subsidiary. Therefore, I will sum this up. That is his own, while NCI will only take share of the parent. So share of the subsidiary. That's 1/5, and that is that. Now, transactions within equity or transactions with owner of equity. Remember, there was acquisition during that year and there were issues of shares. Therefore, shares issued in acquisition of Upper Limited, that's the subsidiary. Remember, we said we should increase share capital. If you go back to note 1, we have to increase share capital by 16.8, and we have to increase share premium by 119.80, and that is that there. Also, we recognize for the first time the amount of non-controlling interest, which means added on acquisition of Uber subsidiary. That was the first time we are recognizing non-controlling what? Interest. And non-controlling interest was recognized at what amount? At fair value of 60,600. And that is that. Therefore, we have that. Okay, now what is the share capital? The initial share capital of the parent prior to acquisition was 100. Okay. Now, there was no NCRs at the beginning of the year because the acquisition occurred during the year. But what is left for us is the retained earnings brought forward. Therefore, that's the last working we do. And which means we need working on consolidated retained earnings brought forward. But because we are aware that there was nothing like subsidiary last year, it then means that the consolidated retained earnings brought forward is nothing other than the retained earnings of the parent as at the beginning of the year. Which means it will be the retained earnings of the parent brought forward. And that is the retained earnings at the end of the year, which already included profit for the year, minus the profits made by the parent in the year that has increased retained earnings by 76,605,000. And that will give me my retained earnings. Okay, sorry. That'll give my retained earnings. Let me put it here. That is 235 600 minus 76,605. Remember the way we do it in class, therefore, I can now show you here, which is this minus whatever we have here. Okay, that is that. Now, naturally, we are supposed to add plus or minus. Plus or minus our post-acquisition retained earnings of subsidiaries brought forward. But unfortunately, there was no subsidiary brought forward. Therefore, this will be nil. Remember, its acquisition during the year, which means as at last year, there was no subsidiary, therefore nothing to bring forward. And if that is the case, I just sum this up, and I have 158.9, all because, let me highlight it in red to call your attention to it, that there's none, in this case, not applicable. Why? Because it was acquisition during the year. Therefore, I can just link it straightforward. My consolidated retained earnings brought forward is this. Therefore, I can sum everything up in one. And what do I have? This is this. I can do that for everyone. Therefore, sum equity of the parents together. Sum NCI and equity of the parent together to get total equity. And see whether it ties to what we have as 540,118 in the balance sheet. Okay, we have 508,518. Let's check what have we done. This is share premium. Is this evaluation? Yeah, okay. This is 2, yeah. That's therefore when we look at this 214, the revaluation, did you capture this? Okay, we didn't capture the revaluation. Yes. Even the balance sheet agreed, but we didn't capture this revaluation. Okay, 26,500 and this, which means in the adjustment we made in the balance sheet here, let's go back to it. We revalue count upward, we didn't capture that revaluation. That is total error of completion, complete omission, which means we need to have added the revaluation surplus. Okay, it will affect both the assets and it will also affect the reserve, because this we're told, if you go back to note 7, it happened at the end of the year. Therefore, which means we omitted the creation of revaluation account, and therefore I can shift it down a little. To valuation reserve, other components of equity. Okay, therefore the same amount will have gone into, and I think it's because we didn't show the accounting entry, that's why we slightly nearly missed it. Therefore, it comes back, and I can sum it up. Yes, we can now go back to our 540,118. Can you see 540,118? 540,118. Therefore, I think I would advise that instead of saying noted here, let us pass the entry into the account. What's the accounting entry? If let me just copy one accounting entry here. Okay. When there's evaluation, what do you have to do? Recognize that evaluation. This is again, you debit group property, plant and equipment, and the gain goes to the parents. That's the evaluation reserve. That's for the parents. And the other one goes into non-controlling interest. And this is the reason why I always try to advise people to pass the entry, like you can see it. Now, the total evaluation is simply what happened in the year according to the information. 7. The gain on evaluation arose from an independent valuation of the group property in September 2022. Therefore, we are going to add these two together. Okay? And I'll come to evaluation reserve. If you go back to evaluation reserve, you find out that in the working of attribution year, what goes to the parent is this two. Therefore, I'm going to sum these two together for the parent. While what goes to NCI is just one. That is the attribution of 1.5 for the subsidiary. And that is the entry with evaluation gain on groups, property, land, and equipment. And that's the position there. Okay? If that is the case, I can take this up back. And that's it. Therefore, you can see that we can cross-check that the total equity independent of statement of change equity tallies with the total equity here. Likewise, the equity of the parent, 481.81, also tallies here, 481.81. Therefore, my evaluation surplus here is the portion that belongs to the parent. What portion belongs to the parent? I go to my accounting entry, 3,100, and there's another portion that goes to what? NCI. Okay, and that is that's 5, and that is it. Okay, therefore, equity attributable to shareholders is 481.81, which you also see here, 481.81. The one that goes to total equity is 540.118. The one that goes to NCI is 59.938. I can see them there, 59.938, 540.118. And that is just everything. Therefore, I believe we are able to make justice to this. Any question at this point? Somebody said the pre-acquisition reserve figure ought to be 50,550 minus 14,738. Remember that it's not supposed to be 14 because we've forgotten that we acquired 3 months into the year. Therefore, the 14 what we have here, the preposition, you said is 14, yes, and that's what we did. Where is it? Pre-acquisition reserve. Is it pre, you mentioned, or post? Post-acquisition, you meant to say, not pre-acquisition. And that's what we have done somewhere here. Okay, that's under consolidated retained earnings. Yes, that's what we did. And it's from there that we more or less apply the percentages. Okay, hope you are clear now, Mary. Okay, any other question? Any other question, which means, okay, yes, thank you. That is that. I think I'm going to share this workbook with you, and I believe you guys are home and dry now. Okay. Another thing here is that in the consolidated statement of equity, I can equally, more or less, extend this by showing revaluation. Okay. If I decide to extend it by showing revaluation as part of my reserve here, I can still do the same thing here for the benefit of that of some people, but they are still going to give the same results. Now, what will only happen is I'll come here and say the revaluation gain. Therefore, the one for the parent will come here for the parent. Okay, let me just I'll say for Olu. And there's gain for Ola. Sorry, not Ola, Oba. Olu gain will go totally to the parents. Oba will go to the parent and NCI. Remember our ratio, 70 and 30. Therefore, I can just link it. And if I link it, I won't need to, I'll just link this one. Here. Which is the same thing. I'll now link this one. Here, which will still give me the same position as we have it before, just for clarity's sake. Okay, and that is that. Now, that is that. Okay, if there's no other question, I think we've done justice to this. And if you go back to the question, I think there's an extra question given. Let me check. Let me try and copy. But that's a bonus mark for you. And that question is question C for 4 marks. Okay. And if you can read question C, this is it. Can somebody volunteer to read? Raise up your hand and let me allow you to read. Who is volunteering? Can somebody raise up your hand, please? Okay. Mary, kindly unmute and read that question C.
Can you hear me, sir?
Yes, we can hear you.
IFRS 10, Consolidated Financial Statements, state that a parent must present consolidated financial statements in which it consolidates its investment in subsidiaries. Required, state 4 exceptions to the above pronouncement of IFRS 10.
Okay. Now, remember we discussed issue of exclusion of subsidiary from consolidation or exemption of parent from consolidation and exclusion of subsidiary for consolidation. Now, in this case, they are simply asking you, what are the cardinal points or principles that will make you exclude subsidiaries from consolidation? And remember, we have discussed it severally, and I'm going to put it here once again. And also, I want you to read those 4 cardinal points that can make you exclude subsidiaries from consolidation. Okay, can you proceed to read that? Okay, I've given you access to unmute again. Go ahead.
Exceptions to the rule of a parent company preparing consolidated financial statements. IFRS 10 provides that a parent need not present consolidated financial statements if any or only if all the following conditions apply. 1. The parent itself, that is X, is wholly owned subsidiary with its own parent company. Alternatively, the parent is a partially owned subsidiary when its own parents and the other owners of X are prepared to allow it to avoid preparing consolidated financial statements. 2. The parent debt or equity investments are not traded in a public market. 3. The parent does not file its financial statement with a Securities Commission for the purpose of issuing financial statement instruments in a public market. And lastly, the parent's own parent or the ultimate parent company, for example, the parent of the parent's parents, does produce consolidated financial statement for public use that comply with IFRS.
Yeah, that is it. Now, let me explain it one by one, which means if you are a wholly owned subsidiary of another parent company, that parent company prepares IFRS and adopt IFRS and prepare consolidated accounts. That is the first condition. Or if you are even partly owned, that means you have non-controlling interest. And those non-controlling interests equally agree with the parent that since the ultimate parent prepares consolidated account, therefore, it need not prepare. That condition is also met. That is one. But in addition to that condition, you must equally meet the condition that the debt or equity of that parent entity is not traded in the capital market or are not listed in the capital market, which means if the parent company is a quoted company on the Nigerian Stock Exchange or any exchange, is compelled to present group accounts. Even if it's not quoted by shares, if it issue public debt, such as bonds, commercial papers that the public subscribe to, therefore that condition is not met, which means unless it's not having any instrument, debt or equity traded in the market. Now, the other aspect is that in addition to the first two, It must also meet the condition that it's not in the process within the next few years, maybe 3 years, in coming to the market that will require it to file financial statements with the Securities Exchange Commission or equivalent commission of such status. And in that case, he has met the third condition. And the fourth condition is that the ultimate parent of that company prepares consolidated accounts and it prepares it in compliance with IFRS. But if he has met the first three conditions, but the parent prepare consolidated account, but not in IFRS, just because the parent is a US company, and maybe it's not preparing or adopting IFRS as a standard, therefore, he has not met that condition. Which means until all of these four conditions are met, a parent company can never take this exemption or exception narrow not to present consolidated financial statements in line with the requirement of IFRS 10. On this premise, thank you very much and God bless you all. I'll make the video and the work paper available for you for your use. Thank you and God bless you. Bye.